fantastic speakers on manager selection. They really cover the gamut of different topics on there. So, you know, many of you already know Robert, and Robert's helped me host or co-host events in the past. So, Robert, why don't you introduce yourself? Tell us where you are, because I know that you're in Austin, but you really aren't right now. So, and everybody in Austin is kind of laughing right now because they know you. So we miss you. Anyway, speak up and introduce your group.
All right, thanks, Marty. I'm currently hiding out in Tucson, but I do plan on getting back to Austin, where I've been living the last 5 years. I was able to get my first shot on Saturday. That was pretty exciting. But, you know, missing everyone in Texas. Look forward to getting back there. As Marty said, we're going to be talking about manager selection. I think I've hosted a few manager selection discussions in the past. Right now, I'm an independent consultant and currently working with a private intelligence firm that helps investors with due diligence. I'm going to ask all my panelists to introduce themselves, a little background on them personally and their firm, and how they play in the manager selection process. So as an example, currently with my work with the private intelligence firm, mostly focused on working on due diligence once a manager has made it through the initial screens. And I'll just go around based on who I see popping up closest to me on the screen. So Chip, looks like you're up first. Can you tell us a little bit about yourself and where you play in the manager selection process?
Good morning, everybody. Thank you for having me here, Marty. Robert, nice to see you. My company is Perkins Fund Marketing. I founded it May 1997. We are a placement agent, third-party marketer, however you want to look at it, made up of senior people. We've got 8 people on our team. We are registered and licensed with the SEC, FINRA, the MSRB, in over 30 states in Canada. Have also been registered in the past, depending on the demand, in Europe and Switzerland, which is also in Europe, of course. We've raised about $7 billion for alternative asset managers over that period of time. 3 people have been with me approximately 20 years. So again, senior group. And we work only with alternative asset managers, primarily hedge funds, and have done this from the beginning. Where I fit in the process, I'm ultimately responsible for the managers that we take on. We take on about 5 to 7 at a time that we present to institutional investors, doing all the marketing and material work for them. We've done distressed, event-driven, long-short equity, sector-specific, convertibles, you name it. Any kind of hedge fund that has a quality group behind it, we've probably represented in the past. I'm very happy to participate on this panel today, and happy to discuss the topic of manager selection. So let's go for it.
All right, thanks, Chip. Laurence, how about you? I see you're unmuted, so I'll let you go next.
Great. Hi, Robert. Good to see you. Good to see everyone. Great to be here. My name is Laurence Richards. It's called Legacy Road Family Offices, and we oversee the group of a group of families as investments here in the Los Angeles area, investments in the public and private markets. We do a lot of investing in different So we have quite a fair bit of experience looking at manager selection, analyzing the very different factors concerning manager selection, and being fortunate to invest in a variety of different funds, which can be very exciting.
Right, thanks. And Kevin, do you want to take it next?
Sure, thanks again for having us. I started SineCera Capital in June of 2019 after working for a large private bank, and before that a large RIA here in Austin. And the bulk of we have a small set of families, so we're an RIA, but we're structured more like a multifamily office. So we have a small set of families that come from real estate, oil and gas, fintech, biotech, media, telecoms. We have a number of folks in that different background, but the majority of the managers that we're looking at, our overall thesis that we've been tasked with by our families is looking for things that have realistic IRRs, reasonable multiples, and potential for cash flow along the way.
All right, and Panayiotis, you want to give us your little intro? And so far I think you're the biggest pool of capital on our panel, so congratulations.
It's not my capital. I wish it was. Good morning, everyone. My name is Panayiotis Lambropoulos. I am a portfolio manager at Texas CRS, a $31 billion public pension plan located here in Austin, Texas. I'm one of 5 team members that focus on the trust's hedge fund and alternative investment allocations. We have several pools of capital. We have our absolute return portfolio that serves as a risk mitigator to the trust. We have an emerging manager program that seeks to invest in smaller and emerging managers. But that is in partnership with PAMCO Prisma. We have a newly approved opportunistic credit mandate that's targeting 3% of trust assets when fully allocated. We're close to making our first core investment there. And we have more return-seeking structures as well, short extension strategies. Most of my focus is on hedge funds. And as I mentioned, now diving a bit more into less liquid structures with opportunistic credit.
All right, thank you. And we've got a bunch of questions that everyone submitted, mostly around the due diligence process. But before we jump into those, I just wanted to go over quickly with the panel, kind of where do you get your manager ideas? How's your sourcing process? And I'll kind of go reverse order, maybe. Panayiotis, do you want to touch on that and where the ideas come from?
Sure. I don't know if at this point, given the maturity and institutionalization of the industry, I don't know if we're that unique from other peers, but we obviously use a consultant. Allborn is our consultant on both our opportunistic credit and hedge fund program. We used to attend conferences. We continue to do so virtually, but hopefully we'll do so in person. We speak to other peers. We look at publications. I've been in the industry almost 20 years. So at this point, I have my own Rolodex of confidants and people I trust that I share ideas with. Speak to people like Chip from time to time. So there's of different ways to find out who's out there, but also another source are the managers themselves. Also, if you get to know the management team, potentially any spin out, somebody leaving that firm, you get to know them ahead of time. So it's a combination of avenues to find ideas.
Right, thanks. And I guess, Chip, you got teed up by Panayiotis there. So a little more insight in how you source the managers that you end up working with.
Well, it comes from many directions. Probably mostly we get contacted directly now after 25 years of doing this. A lot of the prime brokers, a lot of consultants will give new managers, younger managers, our name to contact us, which they do. And I've got a director of research, Doug Newsom, who spends a lot of time along with me fielding balls that come in. But we also go out looking. We read a lot of publications, and if we hear about somebody leaving an established manager, we want to get in line and reach out to them and try and be there first and see what kind of opportunity there might be for that.
Right. And how about Kevin? Anything you want to add on sourcing new managers?
I think that's right along the way. We, I would say we actually recently did an evaluation of 2020 and all of the due diligence that we completed in 2020 with our team. And about 80% came from our existing networks. And I think it includes a number of the areas that were just discussed in terms of, just existing relationships, people we knew, folks we met at conferences that reached out to us from speaking on panels at other family office events. But also one of our founding families that joined me when I started the firm previously ran for a large pension plan here in Texas, all of the private equity, and pioneered the emerging manager program for that particular pension. And so because of that, we get an opportunity to see a lot of deal flow from his side. And really, because we're a small multifamily office, our families have been seeing deal flow for a very long time. So we get a lot of deal flow from them as well.
All right. And Laurence, did we leave anything for you as far as sourcing ideas from managers?
Well, I get ideas from a variety of different areas, often just relationships through different funds. People come to me through them. Sometimes actually people leave funds. I have an interesting situation. Someone left a fund, a named fund, and they started up another fund with some other people, and they actually are now a senior partner at this fund. So sometimes they're spinoffs. Some of my clients, I oversee the investments of a group of families. Some of my clients will bring me managers that have approached them or they know through their network. And this is in addition to sometimes even
That was an important
Like,
part.
Laurence freeze a little bit, or is that just me?
No, you froze.
All right. Well, we can jump into some of the questions that you guys sent earlier that, mostly focus on due diligence. And I'll start with you, Kevin. I think you gave some nice, high level questions. So what is the most important part of your due diligence process with selecting a manager?
People.
Start at that level.
People. It's always about the people for us. I'd say 80-90% of the due diligence is about the people. Is the team capable of delivering on what they are saying they plan to deliver on? And we look at things beyond hedge funds as well. In fact, most of what we're looking at is really private equity. And so looking at those people, seeing their experience, and if we get down to the point where we're actually going to move forward and put an actionable rating. So one unique thing we do for our families is we have a rating system and a grid and a written due diligence process. And so our families don't just say, hey, what do you think about this? They say, what do you think? And should I invest in it and how much? And so when we go through that process, really getting down to finding out, who's involved in the company, not just who is on the management team, but also who else is backing the company and what resources are they bringing to help that company be successful, or that fund, or or the pool of capital and resources.
Hey, Robert, I just want to jump in here 1 second.
Yeah.
You forgot about Scott Cheskiewicz?
Didn't mean to forget Scott. Scott, are you going to join where Marty's hanging out live in person, or are you getting on Zoom?
I'm here live. Can you see us here?
Yeah. Yes, we can see you.
Okay. All right. That's cool.
I apologize. We sort of know you already. So I'll jump back real quick though. Can you share a little bit about, how you get?
Don't worry about it. They all heard who I am. No, go ahead. Just pick it up. I just wanted to be sure that you knew I was here. That's all.
All right. Well, I want to follow up actually on Kevin's comment about looking at people. I think, a couple other panelists mentioned that as a key part of the due diligence process. So if somebody wants to jump in and elaborate more on how they look at the people involved with the fund and any key characteristics, and, how do you handle investigating people when you can't sit down with them in person and look them in the eye and shake their hands during COVID?
Robert, this Chip, we very much like Kevin, it's about integrity, honesty, ability to build an organization, the pedigree and portfolio management. If they have that in the past, if they're not just a startup, that's obviously extremely important. We analyze all aspects of their returns, their Sharpe ratios, everything. But it's really, where do they come from? Who are they? And then we do background checks, and we ask lots of questions, not only of them, but of their references. So it's a thorough investigation. And, the only thing you can't do with Teams and Zoom is shake their hand and look them in the eye while you're shaking hands. We have found that we can do 96% of what makes me comfortable looking at managers now. But it's hard to pull the trigger. I'm looking at a guy right now who's in Vancouver, and I can't even get into Canada. So I have to do it all online. and people are starting to realize that this is the new reality, and they're going to save a ton of money on travel expenses by, you know, understanding and believing in this, and then being able just to go and you know, make one trip when it opens up.
Yeah, I guess I've added a few things. I more or less agree with everything that's been said. Obviously, it all does come down to the decision makers that make the investment decisions. I would say people matter. I would say even more so when you're conducting your ODD as opposed to your IDD, especially early in the life cycle of a fund. Most funds last on average. I'm talking about hedge funds, 3.5 to 4 years, and most of the failures come due to operational shortfalls. So having key competent people on that side is paramount. But when it comes to the PM, definitely look for a desire to succeed and build something that matters to them and their team, the ability to communicate with both internal and external stakeholders, a high emotional IQ. We want people that have the ability to have a conviction, have no fear of making mistakes, but also have the ability to listen. When they do make mistakes, have the ability to listen, to put together information from various sources and put them all together. The ability and willingness to be contrarian and think differently perhaps than their peers of the market. And also a keen self-awareness of their strengths that they can fully exploit and weaknesses to mitigate or address. And when it comes to the new age, I'm not of the belief that we're completely migrating to the world of Zoom. This is still a people's business. For those that are still hesitant, I believe that all it's going to take is that first fraud that happened over Zoom, and we're going to revert back to trying to be on the ground, meet people, see the buildings, meet the handshakes and everything that comes along with that. I think Zoom will be an augmentation tool. Database rooms will be augmentation tools, but they won't replace the traditional IDD and ODD process.
All right. And Laurence, kind of following along on people, we talked before getting ready for this. I believe you said that the 3 areas you look at in evaluating a manager are strategy, performance, and intangibles. And if you're still there, I think I just lost. Oh, there you are. So if you're still there, can you elaborate more on the intangibles that you look at when evaluating a manager? Or maybe you froze again. All right. Well, I think Laurence froze again. So move on a bit. I guess getting a little deeper into the due diligence process, Scott, I'm just wondering, what are some of the issues that come up, when you're getting involved on the legal side of the due diligence process that can kill an investment in a fund?
Yeah, sure. And I think you phrased that right, because in my role, I come in pretty late typically. And obviously I'm not involved in selecting managers per se, but what can come out of my review can eliminate managers. So I can't help anyone get an allocation, so to speak, but if your documents aren't well written or reasonably well written, consistent, and reflect the deal as it was sold to the investor, that can certainly eliminate you. So one of the and this kind of ties in with what somebody else said. One of the things I see, and this is more in the private market space, but sometimes in the public market space, in the hedge fund space as well, is what sort of key person event terms are in your documents. And so there's always this tension with money managers who don't want to include too many persons as key persons because of the internal negotiation dynamic on compensation and how, if this person leaves and they know that they leave and it's going to blow up my fund, suddenly you're handing them a lot of power in negotiating their own compensation. And it might be somebody who wasn't there in the beginning versus the investor side of the equation of, yeah, we're really buying this fund based on these 2 or these 3 persons, not just the original founder. And so that's a conversation that should really happen a lot earlier than I see it happen. Quite honestly, and it's one of the items in my due diligence checklist when I'm reviewing funds is what sort of key person terms are there, are these acceptable to the client? And it's actually amazing to me of how many of my clients have thought about it only superficially before it comes to the legal review. Because there's not always a straight answer right away. It's like, oh yeah, we need to think about that. But it is the team that you're buying, right? More than anything else. So I would recommend to all the investors on the call, think about that very early, and really decide what your position is on that early, because it can, I've seen it, it's not that often. Usually we can resolve it, but I've seen it kill a few deals where there was just a line in the sand drawn by the manager of, we're absolutely not going to add, him or her to the key persons, or we won't give you a trigger of on each individual person before you get some sort of exit right or suspension of an investment period or something like that. And the investor was just like, look, we actually believe that the person you're not adding is more valuable today in the fund. You're sort of living in the past with your key person event. So that would be like my one suggestion for both sides of the equation, really, to one, for the managers be open to that and recognize the current reality. And two, for the investors to really think about that very early on and really even check that before it goes to outside legal to me, because if that's going to kill a deal, and I've already spent 20 hours of work before I have my first conversation with a client, that's dead deal cost that nobody wants to incur.
Right. And then, I'm curious, Panayiotis, not to pick on you with all your capital, but obviously the audience is mostly family office, high net worth. Do you think there's key differences in the due diligence process at ERS? And then could you also add a little bit more color on the emerging manager seeding platform you guys have that you're working on?
Sure. The one quick follow-up to Scott's comments, I would agree on the timing on the legal. We do have a luxury of having our own internal legal team here at ERS to be our own eyes and ears on key issues, and we involve them early as soon as we receive the PPM documents. That way we're not wasting our time of putting in 80, 90 hours to do a full due diligence. So I would agree on the timing, do it in the beginning, not at the end. Before ERS, I was in the fund of funds world. I started my career at Grosvenor Capital Management in Chicago, the pioneer of the fund of funds industry in 1974. I've also worked at another fund of funds that's Tokyo based, again in Chicago. So I've done the private, I've done the public, haven't had the opportunity to be in a family office or an endowment. Personally, I believe that the spirit of any IDD and OED remains the same regardless of the business model. You might have access to certain tools, like for example, an internal legal team that others may not. But overall, I think it starts down with the definition, understanding what DD sets to accomplish. And I don't think that changes whether you're in my seat at 30 billion or multifamily office at 3 billion. It doesn't matter. In my opinion, your due diligence attempts to assess if the foundations that contributed to past success is still present today, which gives you and the LP or the GP and the strategy a better than not probability of succeeding in the future. That is at the end of the day what you're trying to accomplish. And overall, the approach that we take is that we're not investing in a fund, regardless of size. We're investing in a business that happens to manage capital. That's how we think about it. And it ties back to the awareness of people. Of course, given who we are and who we manage capital for, we look for institutional caliber investment firms. But our qualitative and quantitative assessments, I don't think differ that much from anybody else. From a quantitative perspective, we look at many similar statistically based performance measures. But at the end of the day, what are you looking for? Statistics tell you something that already happened. They tell you about the score of the game. What you're trying to assess is not just the quantity of the returns, but also the quality of the returns. And how do those returns tie back to risk management philosophy and investment objectives and return objectives? And we overlay that with key periods of performance in the markets to assess, was there style drift, was there luck? Did they do and perform the way that they said they would perform? We touched a little bit on the qualitative. We're looking for quality of experience across all team members, front and back office. At the end of the day, we're trying to get an inside look and a roadmap to their thought process. How is it that they source ideas? How is their throughput of looking at those ideas, and how do they execute? We look at culture. We look at the opportunity to work one-on-one with managers as well. And obviously, we're looking at terms and conditions for that fund. In really simple terms, if I had to come with an acronym, we're looking for facts: flexibility, adaptability, consistency, and transparency. You're looking for flexibility and adaptability to a strategy that can conform to market opportunities, but not style drift. You're looking for consistency in process across the board and execution. And you're looking for transparency. You're looking for a partnership. It changes a little bit with our emerging managers because you'll focus more on operational risk early on. But I don't think overall the principles that drive any IDD or OD process change.
All right, thank you. And we want to keep the audience happy. There's a couple specific sectors that everyone seems very interested in. Venture capital, private credit, and we can't avoid crypto. So I guess, question on all three for the panelists, do you think any of those sectors are overblown? So we'd love to hear comments on that. And, how do you maybe adapt your due diligence process by the sector or type of fund? Kevin, do you want to jump in on that one?
And also, I just want to jump in here. Can you just talk about your process? Because, obviously, crypto's been blowing the doors off things for about 7 years now, and most people have been ignoring it. So have you guys created like a specific group that addresses crypto, or, where are you on that? In one perspective, and I'll give you a great example. If you invested in digital assets, you probably did pretty well. If you invested in blockchain ventures, you probably did well, but not as well as in digital assets. So if you guys can talk about it and differentiate, that'd be great.
Sure. Yeah, I would say we are probably slightly behind in the crypto space. We've had a number of families take positions in different currencies, but we haven't formalized anything internally around the crypto investment space altogether. However, we are starting to take a much deeper dive in the blockchain because I think it will have an amazingly transformative effect on the underlying data of how we do things. I've had a number of discussions with folks in the space saying that blockchain has the ability to do things like eliminate insurance underwriters eventually, and things of that nature. And so we're still at a very high level looking into that and haven't formalized anything around it in that space.
And Chip, any comments on the excitement in venture capital, and if that's overblown, or due diligence thoughts on venture versus private credit, or any general thoughts on crypto investing?
Well, I don't know if I'm just not smart enough to do crypto yet, but I've been reading a lot about it, and we've been looking at it. But we have found that there's plenty of interest, for us, because we take on a limited number of managers, in things like private credit, in Spacks, in actually fundamental long-short equity, once again, where people are actually doing the work, in China, electricity trading, real assets, natural resources. We're looking at all that right now and finding some very, very interesting products and opportunities. Crypto, I don't know. I was born in 1955, and I still carry $100 bills. So people look at me like I'm a dinosaur. But I'm trying to figure it out. But if I can't, the way we do things, if I can't personally invest in the manager and view it as a personal investment opportunity, we don't do it. And until I get it, we're not going to do crypto. That's just us, and we're one shop in many. Venture, I think venture's always been a very exciting time. I think that there's just so much money chasing private right now, whether it's venture, whether it's private equity, whether it's private debt, that it's hard to think that you're going to get a decent deal. Because whatever you think its value is, whatever it may be, somebody thinks it's worth more because they just happen to have more money than you. And so it's a market I'm on the sidelines of right now. I'm looking for opportunities for people that can make, you know, decent returns without, and by return, I mean, I had last year, my China guy was up 86 points. My convert and Spack guy was up 56 points. You know, the energy guy was up 38. So I've got, you know, I've had good success without going out of bounds that we are comfortable in right now. And venture right now, we're just not doing it because everybody's doing it. And they're all ready to spend money that I think silly, but that's just one man.
Well, and Scott, to bring you in on this, I'm just wondering, are you seeing sort of a hot area based on the work you're being asked to do? You know, an increase in VC versus PE, that type of thing. And, you know, do you see your work changing much when it's VC versus PE versus hedge, or is it still kind of pretty standard?
Yeah, well, this is just anecdotal, of course. I'm not like doing a big statistical analysis across, you know, everyone, but just from a gut standpoint of what I've seen, I've definitely seen more venture than what I saw 4 or 5 years ago. I've seen, although it's starting to taper off a little bit, for the last few years, credit was really hot, a lot of credit funds. I've done a few crypto funds. Most of my clients will not do crypto. Either they can't from a investment authority standpoint, or they're not interested in it yet. I'm a little bit of a curmudgeon myself about it, and don't really understand it. It seems kind of like tulip bulbs to me. But you know, I'm also not an investment analyst, so. But I've done a couple of crypto funds. And the thing that kind of surprised me a little bit was in the latter half of last year, and especially the first quarter of this year, I've had a bigger uptick in hedge funds. I really thought that was going to taper off quite a bit, and people were just going to sit on their allocations or redeem and allocate to other asset classes. I mean, private equity has been hot for a really long time. I think everybody's a little bit curious and worried about the valuations, but I've seen more hedge funds than I would have expected, and I've seen more venture than normal. And as far as the reviews go, I mean, they're all different asset classes. Venture and private equity are much closer, of course, being closed-end funds. But the terms generally are more manager-friendly in venture. Certainly in the funds that I review, everyone chases, you know, the top quartile of venture, and they know it. And those funds are typically oversubscribed. They've been, you know, bringing in the same investors they brought in for the last, you know, 12 funds, and are you know, killing it all the time. So they don't really move on terms. We've done a few. I've got a client that an endowment that seeded a venture fund. We're on now fund 4, and they seeded it. I worked on that deal, and I've watched the terms. They were reasonable for venture when we started, but they've also shifted in the manager's favor as that manager has done better and better with each fund. Private equity also, the last few years has like 3 or 4 years or so, has definitely shifted the pendulum in the manager's favor. It may be sort of about to swing back. We'll see. And then hedge funds is just total case by case. You know, there's new launches and things that we've done in the last couple of years of existing teams that are broken off, and they've, you know, come in with monster raises for brand new hedge funds. But I also work with a lot of emerging manager programs as well. And we're seeding a lot of new hedge fund managers. And in those cases, you know, our clients have a lot of leverage. So we can do a lot of really neat things on the fees. We can have things like declining management fees based on total manager AUM as the manager grows and things like that, which later investors are not going to probably get the benefit of that. Those are all one-off deals. But that's basically it. I mean, real estate still hot as well. I have seen a dip in energy in the last few years. Very few energy funds have crossed my desk. Decent amount of infrastructure. I expect that's gonna get bigger in the next 4 years or so. And that's about those are all the main asset classes that I review.
All right, Laurence, we'll give it a try again.
Right.
All right, we can hear you. I mean, if you wanted to check or talk quickly about what you look for in intangibles, and then comments on the
Sure,
sectors from the poll,
sure.
BC, private credit.
Great. My sincere apologies. I've had innumerable Zoom calls and it keeps going in and out. I don't know why. But in any case, just a few comments regarding and to touch on a few things Chip and others said. To first of all address the idea of intangibles. One of the individuals was talking about in transparency. I'll talk about transparency.
Oh, I think he froze again. All right, well,
He was gonna say transparency is incredibly.
I can address the crypto if you want, Robert, really quick from an institutional perspective. If Kevin's behind the curve, we're not even in the parking lot when it comes to crypto. I think institutions are going to take a bit longer to get there, given who we are, given who we serve, and the fear of headline risk, given the nuance of, I don't know, I'm afraid to call it an asset class, but whatever you want to call it, and the structures themselves. However, what I would say is we actually seeded an emerging manager that's focused within the financial sector, but broad definition of financial sector. Part of the thesis there was tied to crypto or digital assets. And we felt that we could play it indirectly, whether it's through asset managers that invest in crypto, that way we're not taking the direct exposure risk ourselves, or the fact that crypto and digitalization of pretty much everything is going to affect capital markets across the board and the entire ecosystem they're in, whether it's asset managers, whether it's how we exchange and how we've used storage of value and capital, whether it's payments, electronic payments. So we felt that if we were going to enter, and we do believe in this next frontier of capital market formation, that we'd rather take an indirect exposure through a manager and equity long short with concentrated bets, lower net exposures, as opposed to outright joining the fray of trading a digital currency that may and eventually become the mainstay, but for now it's too early for us to get involved with.
Yeah, and I'll add one just anecdotal story. Anecdotal story to that is I sit on the investment committee for a foundation here in Austin, and we had received a question: do we have the ability to accept crypto donations? And what I'll say is I do believe crypto is here and it's going to be a part of our investment ecosystem for a long time, because the lumbering giants like Fidelity and Schwab actually have a process and a system for ingesting cryptocurrency into their donor advised funds, which shocked me to a large extent. But if they are already there and have found a way to manage those, I think that's a sign that it's potentially going to be around for a while, because they certainly don't step up on things that are new and innovative early. They tend to be a later stage adopter on that stuff.
And all you have to look is over Europe. The ECB is undertaking a study on how to digitize the euro. They're ahead of the US. And we know China is way ahead of everybody else in trying to replace the dollar with a digital currency. So it's coming. It's just a matter of education, comfort, regulation to get us there.
Very much so.
Yeah, hi folks, and just a reminder that David Dray's going to be on. He'll be talking about, because he's been, thick into this for many years now, about the crypto and investing in crypto as well. So my expectations are he'll answer a lot of the questions that we didn't know. But I think that it's becoming a lot more institutional, and I think that institutions have lots of lawyers, and they're going to make sure that the government doesn't mess around with their crypto investments. So whereas if you were in the ICO market 3 years ago, you saw a huge bump up, and then all of a sudden a crash when the SEC cracked down on that stuff. So, but I don't think it's going to happen this time around, because there's just too many institutions jumping into it. And I think that as institutional investors jump in, like MicroStrategy, for example, or and their treasury departments jump into crypto, it's just going to be matter of fact investing. So,
and just to piggyback off Panayiotis' point, almost all the venture funds that I've reviewed in the last year to year and a half have allowed for like up to 10 or 15% digital assets. So whether they're actually investing in them or not, or using them as like, some of it's if they may just accept it from the underlying fund portfolio companies, but they're paving the way for that. So even folks like ERS who may not be investing in it directly, and my other clients, if they're doing these venture funds, they're going to get some exposure, or at least can have some exposure that way.
Well, and we've got 5 minutes left, so one area we haven't touched on are the craze in SPACs. So that may be considered a manager doing one thing. So I'd be curious if anyone has any quick comments on, are they looking at SPACs? Does it fall under your purview? Or any quick closing thoughts, advice for managers or for other allocators? And everyone gets a minute for that. So,
Robert,
yeah,
maybe I can jump in first. I don't know what's going on with the connection. It's pouring out here in Los Angeles. Maybe that's something, but in any case, I just wanted to comment on crypto. Maybe I'll seem slightly like a dinosaur like Chip Perkins in terms of, we need to understand what we're doing. It's hard for me to support the investment, but I increasingly look at it. Each time I look at it, I don't understand it. So I feel like I need a really support, and even the people I speak to can't give me a value on what we're doing. So it's hard for me to tell the families, super high net worth families, some billionaire families, that we're going to do something, but I can say it's completely speculative, but it's just hard to evaluate. Having said that, we're having interesting talks with an emerging manager who is an expert in crypto arbitrage. So we, Legacy Road, have done a lot of merger arbitrage investing. So we're looking at a field called crypto arbitrage, which is just arbitrages between the different tokens and exchanges, et cetera. But again, back to crypto, this is hard for us to get our arms around. I'm sure it looks like it's increasing, but that's just what our position is. Back to venture. My hope is venture is not particularly frothy, because we are invested in venture. I think the key is to align oneself with outstanding venture funds who know what they're doing. And we've invested in several companies that have gone public through SPACs, have been exceptionally successful. So again, I think it's the selection that's there, but again, there may be some frothiness, of course, in the market, no question there. My other point about the type of managers, just to add to the conversation before, we look at not only the performance and the strategy, but I think Panayiotis touched on this, transparency. It's really about the integrity and the relationship and the professionalism of the managers after we go past the usual points of differentiation. So that is critical to the relationship. Are these people you want to work with and things go wrong? And what are they like when things do go wrong? So those are really, for us as a firm, we want to have a tremendous amount of integrity. We want to know that what we're doing has value, and we want to work with outstanding people. And that's our position regarding all types of investments.
All right. Anybody have any other closing thoughts or advice or comments on SPACs in our final 2 minutes?
I can quickly comment that SPACs are nothing new. They've been around for 15 years. It just happens to be the choice du jour today. We have exposure to SPACs, some direct, but honestly, given the frothiness and the amount of capital that's come into the space, the indirect exposure that we get from our managers is actually before the de-SPACing. It's essentially a quick call play or arbitrage, however you want to look at it, or whatever return profile you feel comfortable with. You come at 10, 10.5, they get priced $2, $3 above that, you get out. And that's the quick way of making 20, 30% ROIC, as opposed to waiting for the actual dispatching. If anything, following the dispatching, but we're starting to hear more about, and we're probably going to see, given the high valuations of a lot of these companies and a lot of companies that shouldn't go public, we're going to see an increasing amount of shorting opportunities.
All right, and I think we're at time, right, Marty?
Yes, absolutely. So thanks so much, guys. Really fantastic. So I just want to give a couple remarks here, just wrapping this up. And again, if there's any questions from the audience, feel free to send the questions via chat. The manager selection group will stay on and they'll answer them via chat.